Hello. Hello, hello. Mic test. Mic test. Can you guys hear me? Hello. Good morning, everyone. Good morning, everyone. Can you hear me? This is Sophia. Hello, hello. Testing. I think there's some issue with my mic. Hello. Testing. Let me know if my mic's working. All right. Good morning, everyone. I'm Sophia. If you're tuning in from Toronto or Vancouver, you probably just wrapped up a long week. And if you're tuning in from anywhere else around the world, I hope your week is off to a great start. So no matter where you're watching from, I really appreciate you for choosing to spend part of your morning here with me. Markets are moving fast, information is noisy, and time is valuable. So thank you for being here. But before we unpack numbers, charts, and the headlines, I want to slow things down just a moment, for just a moment. Because in markets, how you think often matters more than what you trade. There's actually a quote from Howard Marks that I live by, and it's especially relevant right now. When it goes something like, when others are fearful, you must determine if that fear is based on fact or based on emotion. Let that sink in for a second. So markets don't move purely on data. They move on expectations, predictions, and human behavior. Fear is rational, don't think it's not. Fear can also be exaggerated, and sometimes fear is simply the market's way of transferring assets from impatient hands to patient ones. My job here in every session is not to predict the future perfectly, it is to observe and react objectively and manage risk intelligently. So now let's talk about the environment we're in. Over the past week, we've seen heightened volatility across multiple sectors. Indexes are reacting not just to earnings, but to narratives, rates, inflation, expectation, and even geopolitical noise, and also policy uncertainty. And I think this is where many traders make mistakes. Many people choose to chase headlines, they choose to follow what the trend is. You may also react emotionally to red candles. So this confuses the movement with meaning. Price moving does not automatically mean trend changing. And also, volatility does not automatically mean danger. And uncertainty does not automatically mean bearish. Sometimes, uncertainty simply means the market is repositioning. That's why we focus on levels, structure, liquidity, and confirmation. Don't follow your gut, not your gut feelings. Always structure, wait for confirmation, observe liquidity, and look at levels. If you're new here, let me quickly explain how I approach these sessions, how I go through our live streams, what we talk about. I don't follow the hype. It's not about the hype. It's also not about calling tops or bottoms for attention. And this is definitely not about gambling. So this stream is about understanding where institutions are likely active. Also, my goal is to identify key levels that actually matter and align yourself with a probability, not emotion. Every trade, every idea, every observation should answer one simple question. Where am I wrong? Where are you wrong? If you can't answer that, you're not trading, you're hoping, you're wishing. Now, I know many of you are coming in with mixed emotions. Some of you had a great week, some of you had a frustrating one, some of you might feel like you did everything right and still didn't get paid. So this is part of the game. Markets don't reward effort. They reward discipline and timing. And timing is not about speed, it's about patience. You don't need to trade every move. You can't even catch the exact low. You just need to be on the right side of risks when it matters. As we go through today's session, here's something I want you to keep in mind. We are not here to predict headlines. We are here to respond to price. Price is the final truth. Everything else is complementary. If something doesn't align technically, fundamentally, and contextually, we wait. We wait for positions. Cash is a position. Patience is a strategy that you need to keep in your core. So, a quick reminder to everyone before we dive deeper. Everything we discuss here is for educational and reference purposes. I hope you join with an open mind and you share with me what you think. Everything I say is not financial advice. I'm just sharing my personal market perspective. I'm not telling anyone what to buy or sell. Your risk tolerance is unique. Your account size is unique. Your responsibility is your own. Protect your capital first. Profits come second. Now, let's take a breath with me for a moment. If this week was noisy, let it go. If last trade didn't work, reset, restructure your mind, setback. Every session should be a clean slate for you. The market doesn't know you. It doesn't owe you anything. It does not leave clues every single day. But you can look for these clues. And our job is simply to read them correctly. Alright, if you're ready, we'll start breaking down where the broader market stands, key levels you should be watching, and how to think about risk going on into next session. Guys, drop a good morning in the chat and let me know where you're watching from. Let me know in the chat. So, when you're ready, let's get into the deeper side. The stock market is about to open in a while. At present, the trend of the three major indices before the market is pretty good. Let's take a look. Nvidia is still holding above our support. Let's look at the three major indices first. So, it is expected that there will be a certain recovery today, but it's difficult to say whether technology can have strong recovery. We will take a look at the performance of some core stocks in a moment. I want to look at Tesla before we get into everything. So as we can see, Tesla rose 2% before the market opened today. 2.37. .46% before the market is opening, because autonomous driving is already being tested and FSD process is advancing very quickly. You can pay attention to today's performance and whether it will lead the direction of driverless driving. It may also be worth nothing, but so Friday was, I want to look at Broadcom. Friday was messy, it was ugly, but as professional traders, we can't act like sailors who threw their compass overboard. Just because waves get choppy, tonight we're checking out emotions at the door. We're going to talk pure logic. Think of this as a surgical autopsy of the market. We need to figure out if this is just a healthy correction or if the patient is actually going into cardiac arrest. Tonight is going to be heavy on technical and macro logic. We're running a stress test on the bond market and looking at breakdowns in major indices. And also answering the million-dollar question. When big tech starts disturbing, where is smart money investing next? So, grab your tea, grab your coffee. Given the week we've had, let's dive in. So, let's clear the air first. What on earth happened on Friday? What happened on Friday? Why did the floor fall out? So, I want to correct a major misconception around. Will the price of Broadcom be repaired? I saw a lot of headlines everywhere screaming, Broadcom's weak guidance and Oracle's drop dragged down the entire market. It's a convenient narrative, it's giving a villain to blame, but let's be real, this is lazy analytics. Blaming Broadcom for Friday's crash is like blaming a single snowflake for an avalanche. So Broadcom and Oracle, they were just catalysts. The real invisible killer, sucking the oxygen out of the room, was the spike of the 10-year Treasury yield. Guys, we have to understand physics of finance. Treasury yields are gravity of asset prices. When gravity increases, everything with high valuation, especially like tech stocks, starts feeling very heavy. But look deeper. Behind that yield spike isn't just inflation data, it's something more concerning, a crisis of confidence. The market is effectively telling the Fed, we don't believe you, although the Fed is trying to talk down the market, capital is brutally honest. Wall Street is currently pricing in a lack of trust. They don't trust inflation is treasury. They don't trust the soft landing narrative. And they start to wonder if the Fed has lost control of that narrative. So Friday wasn't selling chips. It was violently repricing of liquidity risks. Once you understand that, you stop obsessing over one's earnings report and start watching the macro tide. So now let's look at the road conditions. As traders, we have to respect price action, even when the charts are looking hideous. To be blunt, technicals on the three major indices, one moment before I open everything. So now we're looking at the three major indices. First, Dow Jones. This is a classical topping pattern. if you follow cycle theory, we are likely looking at a significant correction here, potentially deeper and longer than we saw back in November. This correction is the one I'm talking about. Do you see that every time there's an indicator? One moment. Let me give an example. Every time we see an indicator, there's this pullback. Indicator, pullback. And right now, what we may be experiencing is a possible pullback again. If you're holding traditional blue chips, consider this your flashing red light. Now let's look at the key levels for Dow Jones, the 30s. One would be here. Second will be here. And third will be the lowest. So whatever the movement is here is where you need to position yourself. There are multiple possibilities and resistance levels, support levels in such an uncertain market. Now, in previous cycles, we see a lot of pullback after, like here, we pulled, if there was a pullback and we bounce. We're looking at a similar topping indicator. But before we continue with that, let's look at NVIDIA. Market just opened. NVIDIA is currently rising and falling, and it's returning to the support 173. I need to reload. NVIDIA is returning to our previous support of 173. There may be a period of shock and adjustment at this location as people react. let's see NVIDIA one moment before we go into. So NVIDIA has been chopping sideways since July. If you've been holding it, basically you're returning to zero and your time and cost was wasted because other sectors rotated. For professional traders, dead money is the same as losing money. Many people, we are currently at the same stage we were in, let's see, we were in August. We've been in an up, down trend with slides up, and now we're back to 176 and closing in near our support at 173. If this were to touch, if now currently if we might touch the 170 line, there may be such movement, but there's also not 100% confirmation on how people may react to this. However, since we're back here since August, many people who bought here are currently back to zero. After a strong multi-month growth for NVIDIA here, it reached a point where price is extended and became extendedly relative to short-term next moving averages. When that happens, even the stronger stock don't keep moving straight up. They pause, they consolidate, or they retrace, so strong hands can re-enter at better levels. Actually, this is a very healthy behavior for NVIDIA. Now on the downside moves, you have to notice something important. There has been no panic volume. There has been no breakdowns in long-term structure, and there has been no failure on key higher time frame support. So, simply to say this is not institutions exiting. This is institutions repositioning at lower levels. When NVIDIA pulls back, it's not going to be sold because the story is broken. It's just being adjusted because price moved too fast. From a structural perspective, NVIDIA is still reaching its higher time frame trend, and this pullback is controlled, overlapping and occurring on lighter volume. So this is a classic sign of consolidating rather than trend reversal. This is where a lot of traders get trapped. They see red candles and they assume the top is in. They short too early or they panic out of long positions right into support. But fear without confirmation is just emotion. Remember that Howard Marks quote we talked about earlier? Do you remember? Fear must be evaluated, not reacted to. So, now let's talk about the levels, because the levels tell a totally different story. NVIDIA holds above the key prior breakout zones and reclaims intraday VWAP or short-term moving averages. This is a slight sign of demand stepping right back in. If the price continues to make higher lows as in we may see this type of movement, higher lows, back, even during pullbacks, the trend remains intact. The real risk signal will be a very high volume breakdown or loss of major daily support. Until that happens, this is a consolidation, it's not a collapse. So remember, context matters. NVIDIA doesn't trade in isolation, it trades with the broader tech complex. Semiconductor ETFs and overall risk sentiment in the market. When you see NVIDIA pulling back, while broader market is also digesting, that's alignment, not weakness. If the market stabilizes, NVIDIA is one of the first name institutions look at for continuation. So here are the key takeaways for my opinion. NVIDIA's recent movement is about cooling off, it's not breaking down. It's also about resetting expectations, not changing the story. It's also about patience, not prediction. Maybe another example we can take a look at was previous cycles. A pullback is necessary in order to for continued growth. So this is all about patience, not about prediction. Let price confirm before you decide your bias. Let structure guide your risk, and don't confuse consolidation with failure. If you have any questions about NVIDIA, drop it in the comments. Now I want to look at the S&P 500. I think this is the only index holding onto a shred of dignity, but Friday printed a massive bearish engulfing candle. The bears completely overwhelmed the bulls. The only silver lining, we bounced off the 6,794. We bounced off the 607. We bounced off of our support level. Buyers step right in at this line. And here's the key question for today. Do you think the S&P 500 can hold the 6,794? This isn't just a number. It's a psychological line in the sand for the bulls. If we chop around above it, we're okay. But do you know what is my nightmare scenario? A rug pull. We open low, fake a rally, then smash right through the floor. If 6,794 breaks, the trend entirely changes. The next major support isn't until, do you know where is the next support level? Let me show you. Our next support isn't until 6,551. This is a massive air pocket. If this air pocket is hit, we're looking at a major reversal. So don't try to catch a falling knife. Let the market prove it has found a bottom first. Let me show you why. If it drops below 6, this is our first support, and this is our second support. Judging from current trends, the three major indices, they all open high and move low today. The market liquidity is insufficient and the confidence in the direction of technology is insufficient. It is obvious that there is a shock here. The fluctuation caused by this shock will significantly strengthen this week because the major events that really affect the market are still on the way. For example, one of the key events that is coming, the European and Japanese central banks have interest rate meeting this week. And also, US non-agricultural data is also coming up. So it should be more difficult to operate this week. So for everyone, how do you think you should respond in anticipation of this market situation? In fact, it's actually very simple. To watch more and move less. If you have already bought some stocks, if there is a loss, take some first. And wait for a rotational opportunity. Do you know what I'm talking about? Do you? What I'm talking about is the non-tech direction. If there is a floating profit, you can take it quickly out and rotate in the market. Currently, it's not my best advice to hold as we are in a very uncertain period. So, do you know what I mean by non-tech direction? I basically, in this type of rotation market, what we're looking at, you're not being rewarded for holding everything long term. Capital is rotating, not trending in a straight line. So, if you already have profits, floating profits, this is where you actively risk manage, and why it matters, management matters. You move in, you take profit, and you move out quickly. This is not an environment where you sit and hope. It's an environment where you respect rotation, respect momentum, loss, and respect time decacy. Right now, non-tech sectors right now are being traded, not invested. They are responding to short-term flows, not long-term convict. That means shorter holding period, faster profit taking. And it also means tighter risk control. And if the momentum stalls, you don't argue with it, you step aside and wait for your moment. In a rotation market, exposure is tactical, not permanent. And the traders who survive are the ones who adapt, not the ones who stay stubborn. That is the mindset you need right now. So I hear some of you shouting, "Oh, Sophia, the Fed has just announced they are buying $40 billion in short-term bills. Isn't that QE? Isn't that bullish?" Great question. Let's look at the mathematics. Buying 40 billion in T-bills is not QE. It's something like a band-aid, and it won't fix a broken system. It may fix some plumbing issues in the repo market, but it doesn't fix the structural problems in our current economy. More importantly, the market has built up tolerance. When capital starts voting with its feet, these technical liquidity injections don't move two needles. The message from the street is clear. Until we see hard data economy is stabilizing, we aren't buying the dip just because you printed some cash. So, one quote for you guys today from me. Don't get intoxicated by the headlines. On Wall Street, confidence is the most expensive currency. And right now, the Fed is overdrawn. If the market is shaky and the Fed magically tricks didn't work, what about our darlings? The tech stocks everyone owns, are they dead? This is the core of my today's analysis. We need to talk about opportunity costs. I believe many of you are heavily overweight in the Magnificent Seven, but look at the data. Let me pull up some data. Let me pull up a comparison chart. But look at the data. Except for Tesla and Apple, everyone is bleeding. And this is a trend. So we already saw Nvidia. We're back. Now we can look at Meta. By the way, guys, if you were looking at my stream yesterday, what I said about our previous support line became true. We did bounce as expected. But now that's not the important part. Do you see the overall? Now let's look at one more before I make my key point. We're talking about the MAC 7 now. Do you see the overall growth here as well? This is Amazon. And one more before I make my key point. Do you see what I'm seeing? Now, let me explain why they are all bleeding except Tesla and Apple. This is all a trend, and all you need to understand, a trend of this magnitude isn't caused by investors selling, normal investors selling. This is institutional distribution, and the smart money is unloading. So one quote and one physics, basic physics for you guys. Capital always flows the path of least resistance. Let's go back to Meta to prove my possible point. Support 1. Back to support and outgrowth. For the last 2 years, this is a very clear rotational cycle. First thing we have to notice, Meta already had a strong impulse move up. Very strong. Since April, very strong impulse move up. What we were looking at for Meta was up, pullback, literally up, pullback, up, slight pullback, up, slight pullback, and we are seeing lower lows here. So after we retraced, but we stayed above our key support level, then what we saw was another surge, drawback surge. And now what we're looking at for Meta is a rotational cycle after a strong impulse move up since April 2025. This pullback was not random. It stopped exactly where Buyers previously defended. Do you see the previous defend line? Where previously people previously defended. From here, price bounced and formed a lower high. The lower high is important. It tells us momentum is no longer accelerating, it's compressing. And now look how price is behaving around moving averages. Instead of reclaiming and holding above them strongly, Meta is stalling underneath and moving sideways. That's classical distribution duration behavior, not trend continuation. This is why it's not a hold and forget name right now. Let's talk about the path forward for Meta. Scenario 1. If Meta fails to reclaim the short-term averages and loses this current consolidation zone, price is likely to rotate lower, first towards the mid support here, and potentially down to the lower demand zone near the prior swing low, this zone. This would be a controlled pullback. It will not be a crash. And in a rotation market, that's exactly where short-term traders come from, not long-term holds. Now, scenario 2. If price holds this zone and reclaims moving averages with volume, then Meta can grind slightly higher, but notice it would be a choppy and step-by-step move. It will not be a straight breakout. That means even on strength, this remains a trade, not an investment in the short term. Do you know how you can confirm? Volume confirms this view. There is no expansion on the bounces, no urgency from buyers. That tells us institutions are not chasing, they are waiting. And when institutions wait, price ranges. So, what is the key takeaway for Meta? And this chart is very simple for you to understand. Meta is in a rotation phase, not a trending phase. Upside needs confirmation, downside is structured, not emotional. If you already have profits, this is a manage and trim environment. You trade the levels, you don't marry the position. So until Meta either reclaims and holds above averages with volume, or flushes into lower demand and shows real buying interest, this name stays tactical. Watch the levels, let price tell you when commitment returns. This is how you survive and profit in a rotational market. Now let's look at Microsoft. Oh, I'm really wrong. Oops, one moment. MS, what am I doing? The current trend for Microsoft is very bad. In fact, it has formed a double top structure. My judgment here is that there will be a round of major adjustment. So now everyone see that it seems that a new support platform has been built here, but it's not reliable. Therefore, friends who hold this stock should be very careful, and friends who want to buy the bottom should be even more careful. First thing I want everyone to notice. Microsoft already told us the story earlier. You marked it perfectly. Look at my chart. 2 circles, areas at the highs. Both failed continuation and holding. Price pushed up, momentum peaked, and instead of acceptance at higher levels, we saw rejection. This is the first warning sign that upside energy is getting exhausted. This is not bearish by default, but is a signal the trend is transforming. Now look at what happened after the second rejection. Price lost short-term moving averages, and instead of snapping back quickly, it started to creep lower. That grid is important. Fast drops are emotion, slow controlled declines are distribution and rotation. This is exactly what Microsoft is doing right now. Let's talk about our current zone. Price is sitting currently here. This is our former support level. Do you notice any behavior? Anyone notice any behavior? Small candles, overlapping price action, and no strong bounce. This is telling us buyers are not aggressive here. So this is not a dip buy strength. This is waiting behavior. So let's zoom out mentally and think in context. MSFT is mega cap leader. When it stops trending and starts dropping sideways down, it usually means that capital is rotating elsewhere. Institutions are trimming down, they're not dumping, and the upside needs to be reset. This is why, just like Meta, this is not a hold it all time name right now. Here is how I'd framework the market environment we're in. If you're already in profits for Microsoft, sell into strength, buy back lower type of stock right now. You trade the ranges, you respect resistance, you don't chase the bounces. For Microsoft to turn constructive again, you'd want to see a reclaim of key moving averages, acceptance above them. One moment, I'll have a sip of water before I continue. I'm sorry, we had a quick break. I had to go to the washroom and drink some water. I also got some food, so I'm all powered up for the next part. So where did I leave off? So for MSFT to turn constructive again, you'd want to see a reclaim of key moving averages, acceptance above them, and expansion in volume. Without that, an upside attempt are likely to get sold into. Just like before, up, sold, down, up, sold. If the downside, on the downside, if this current support fails, the next move is likely a controlled rotation level lower. It's not a crash. That creates opportunity for short-term trades and not conviction holds. The key takeaway is simple. MSFT is cooling off, not collapsing. Leadership is pausing, not disappearing. And in a rotational market, that means active management wins. Trade it, don't marry it. Let price confirm before you commit. That's exactly how institutions are treating it right now. Let me find the things I need. I have a bite of food. Any questions for Microsoft? I want to go back to Nvidia. One thing I missed out just now was, since institutions are rotating out, why would you fight the current? We don't have the capital to move market. We can only surf the wave. If the whales are swimming to a new oceans, we need to follow them. So the question is, where is money going? Capital doesn't just vanish, it just transfers. In a zero-sum game, we need to find where smart money is hiding. Since SpaceX and commercial space teams are already overextended, we need to take a look for the expectations gap, the area the market has ignored. Here are 4 deep value zones. The AI second curve from CapEx to OPEX, the market is shifting logic. We're done simply buying shovel sellers like chip makers. Institutions are now looking for valuation re-rating in software and application layers. Companies that actually use AI to cut costs and boost margins. What we are looking for, mean reservation plays. Second-tier tech blue chips that lag this year but have fortress balance sheets. So let me just emphasize the AI second curve from CapEx to OpEx. The market's logic is basically shifting. The first phase of AI trade was about CapEx, which was buying shovel sellers, chip makers, hardware, data center infrastructure, and that phase is largely priced in. Now, institutions are rotating towards the second curve, OpEx leverage. The second focus is moving to software and application layer companies that actually deploy AI. Do you know what they deploy AI for? So one is cut operating costs. Number two is improve productivity. And number three is expand margins. This is no longer about AI spend, it's about AI returns. And as a result, the opportunity set is shifting towards valuation re-rating candidates. Do you know what these candidates are? One is tier 2 tech blue chips. Number two is strong balance sheets. Number three is proven business models. And number four, laggards year to date. Laggards, those that have fallen behind. These are mean revision plays, not hype trades, companies where AI adoption can translate into measurable earnings upside. The AI trade is moving from spending to earning finally. After this year, CapEx was the story, Ops is the payoff. And infrastructure build the hype, software will capture the margins. Now we move on, hard assets and commodities. The fiscal dominance hedge. Why gold? Why strategic resources? It's not a fear trade. It's a hedge against fiat debasement. When yields spike, it signals a loss of trust in dollar treasury systems. Institutions allocate to gold not for yield, but because it's anti-fiat. Do you see recently gold? Number three, the trade Dow effect. Pricing power, look at Walmart, Costco. They are crushing it. And do you know why? Do you know why Walmart is crushing it? They are crushing it because the institutional thesis here is the trade down effect. When the middle class gets squeezed, they don't stop spending, they downgrade their spending. These giants have the supply chain dominance to protect margins even when inflation is sticky, buying them recession-proof cash flow. Oh, we're looking at something. Oh, I just noticed this on my screen. We are even lower. The market started to go bad. We're reaching our support level. And the three major indices turned from rising to falling again. Technology has fallen across the board, including applications, semiconductors, AVGO, let's check. How is AVGO doing? Yep. It's falling. Brought again, while finance and medicine, the two low level are currently relatively resistant. It seems that the market still does not believe in technology. We're down here a while, and let me see. Hundreds are down. It's even heading lower. We're gonna surpass our previous support. We might surpass our previous support, but before that, while looking at the charts, let me continue with number 4, defense and new industrials. The geopolitical premium, the peace divider is over. We are entering a secular cycle of global realignment for the defense sector. Institutions aren't looking at next quarter's earnings, they are pricing in a 5 to 10 year sector beta. This is guaranteed government spending regardless of our economy. These sectors sound great, but hold your horses. Don't open your brokerage app just yet. The next minute of this stream might save you a lot of money. Trading philosophy. This map is not a compass. So, stock collection, what to buy, and timing, when to buy, are two completely different skill sets, especially for swing traders. You can get the direction right, but if your timing is off, you will still lose money. Just because I mentioned gold or defense does not mean you marked buy at 9:30 a.m. on Monday. You have to understand a pure institutional mantra. Good company doesn't always equal to a good trade. Every sector, no matter how bullish the thesis, needs to breathe. If you have FOMO into the sectors at the top of the cycle, you will get washed out by 5 to 10% correction. For investors, that volatility is usually enough to force you to sell at a loss right before the stock rips even higher. I believe investing is an art of precision. Macro logistics gives us the map, and technical analysis gives us the compass. We have to take what we're given. We need to sit in the right sector like a sniper. waiting for the perfect asymmetric risk-reward entry. This requires discipline. And this is exactly why I'm launching my private community. Not just to give you tickers, but to tell you when to pull the trigger. Now, let's talk about the elephant in the room. I know we talk a lot about a lot of sectors, but I know you guys want specific big names. Let's do the speed round on the 3 most requested stocks. First, Mr. Apple, the adult in the room. We're currently below our previous support level. And we have one more support for the price. So, from a technical standpoint, Apple remains one of the cleanest structures in big tech. Price is holding well-defined ascending channel that has guided the trend for months. Oh, this is nice. Let me take a screenshot for a moment. That's great. Just so I can add it into my channel. Apple. Now let's look at the August swing low. We're able to draw a... Where's my channel? Look at that. Oops. Before I adjust. First thing I want everyone to look at is this trend line. As long as Apple stays above this line, the primary trend is still intact. Trend breaks change behavior. Do you think this trend line holds, or do we test it? The current consolidation zone This is our current consolidation zone as this line goes, and bottom of the around, let's see, the bottom will be around 267. This should be your decision range. This is where Apple is deciding, and above this box, continuation. Below this box, rotation. So do you think, chat, breakout or breakdown? What is your bias? Recent lows. Let's see the recent lows. This is short-term pressure. Apple doesn't need to crash. It just needs to stop making higher highs. Do you see the lower highs forming? So where is our 20-day EMA? This is our 20. This on our 20-day EMA, this is where bulls and bears are fighting currency. Acceptance above this level matters. Who do you think is winning right now? Buyers or sellers? One scenario that may occur: small bounce. Wait, I'm using the wrong one. Small bounce, rejection, range drop, or breakdown, retest as 267 to 268, a reaction, which we might continue on our existing path. However, in another case scenario, which path do you think looks more realistic? If Apple breaks below this level, Apple changes character. Above it is just digestion. Would you still go long if this breaks? Apple is not broken, it's in a rotational market. Strong stocks don't run, they rotate. Now I want to go back to see what is going on here with Okay, I can go back to Apple. So from technical standpoint, Apple remains one of the cleanest structure in big tech. Price is holding well-defined ascending channel that has guided a trend for months. We've been in this trend for months. Friday's sell-off pulled price directly into the lower channel support, where buyers have consistently stepped in. As long as Apple holds this trend line, the higher low structure remains intact, momentum stays constructive, pullback are corrective, not trend breaking though. A decisive daily close below the channel would invalidate the setup and shift the bias to neutral. Until then, Apple continues to trade as the safest house in the tech neighborhood, offering relative strength and technical clarity in a volatile tape. Now, let's go to Tesla. Oh, we had a pretty big jump today. Let's see now. We actually went over our expected support, which was here. Resistance. We're above our previous resistance. We're looking at a triple thread. We touched, and we went back. Do you think possibly we're gonna go back? As previously, when we hit this anchor point, we fell, and we're up. Do you think? What do you think? Let me see. Okay, let's see for Tesla now. For Tesla, I stand by the thesis from Friday's video. Despite volatility, Tesla's primary trend structure remains intact. Price action has been corrective rather than disruptive, with sell-offs falling to break key higher time frame support zones. As mentioned, that's me. Do you think this price will be rejected as it was? Or is this going to become our new support level? From a technical lens, Tesla continues to trade within its broader trend framework. Volatility has expanded, but no decisive trend in validation has occurred. Dips have so far held structural support, suggesting positioning, not panic. Fundamentally, I think Tesla should be viewed less as an auto manufacturer and more as an efficient and energy platform. Until price breaks its core support structure, the risk-reward framework remains asymmetric, even with evaluated volatility. What are the key technical levels, you may ask? The primary support, the rising 50-day average, orange line, and prior to breakout zone, the secondary support is the last higher low on the daily chart. Higher low. We're looking at our last higher low. I'm talking for short-term trades. In validation, a daily close below the prior higher low, followed by failed reclaim of the 50-day moving average. If that invalidation occurs, the setup shifts from trend continuation to range and risk off, and the efficiency and energy thesis becomes a longer term, not tactical story. Now let's look at Broadcom. We talked about this earlier, but we have to go back. This sellout looks like a fundamental breaking. It doesn't look like a fundamentals are breaking. It looks more like a manufactured, FUD-driven shakeout. The narrative is that hyperscalers will suddenly internalize chip designs and abandon Broadcom doesn't align with reality. Semiconductor chains are deeply entrenched and sticky, not something clients unwind overnight. More specifically, deeply entrenched. Let's see. Let me see what comes up. Let's see live. I'm looking at the live news. One moment. This move lower is not random. First thing to understand, this is a reaction to exhaustion, not a sudden fundamental breakdown. Broadcom has a very strong prior run. Do you see? It has a very strong prior run, and when stocks like this stop making higher highs, these are the higher highs. Institutions don't rush to sell, they trim and rotate. That creates a controlled downside pressure. What stands out in this drop is how it's happening. It looks, chip companies like Broadcoms are embedded into their customers' products at the design and software, firmware, and manufacturing levels. Once a chip is designed in, the entire system is built around it. So, sticky. Customers can't easily switch suppliers without redesigning hardware, rewriting software, and drivers. Requalify manufacturing, risk delays, bugs, or performance issues. Not something clients unwind overnight. Even if a customer wants to build their own chip or switch vendors, it usually takes years, not a quarter or two, and often costs more than staying put. Let me put it in one simple sentence. Once the chip is inside a product, it's very hard and expensive to rip it out. When the market panics on headlines, when the market panics on headlines like clients will build their own chips, it often overestimated how fast they can actually happen. When the market panics on headlines, like clients would build their own chip, it often overestimates how fast that actually happens, creating shakeouts and mispricing. Technically, Avgro Broadcom has rotated back into a defined consolidation stage and is going into a drag down. Key technical framework, major support was our 335. This was our major support. This was our previous, and currently I'm not sure, can we call this a free fall? A small free fall? But this is not a fake trade. You need to wait for confirmation. Where does it stop? If selling volume runs near, then you are best to wait. If the price continues below the setup failed, we set aside and preserve capital. No guessing, no narrative. Price plus volume decide. Alright, we covered the logic, the tickers, what is the game plan for the opening bell. Given Friday's panic, we'll likely see a gap down open on Monday, what we're seeing now, followed by potential reflexive bounce, but be very careful. Do not chase the first 30 minutes. We need to see the volume on that bounce. If it bounces on low volume, that is a dead cat bounce and it will roll over. The best strategy right now, sit in your hands. Investing is a marathon, not a sprint. If the market washes out like this, return of capital matters more than return on capital. Finally, I want to promise to you Whether the market rips or dips, I'll be here every day, breaking down data, breaking down the hard parts. In an era of noise, following the herd is easy, but independence thinking is expensive. If you aren't satisfied with reading headlines and you want to build an independent framework and gain an information edge that puts you ahead of the crowd, then make sure you are subscribed. Let's find the signal in the noise together. I'm Sophia. I'll see you tomorrow. Thank you all so much for joining today's live stream. I hope to see you in the next one.